Hi, everyone. This is Jason Bierek of Wall Street from Main Street.
And this is Lee Justo from Risk.
Welcome back to another episode of Finance Unspun. This is episode number 10. Now, Lee, I think the main topic that we should bring up, and pretty much almost everything else fits under this headline, is what's going on with the dollar. Now, on Sunday night, we almost had the British pound. It almost collapsed. It's still falling. It's close to getting to parity with the US dollar. When was the last time the British pound got this close to being with the US dollar, being close to parity with the US dollar, Lee?
I believe it was in 1985 when it was 1.06, very close to parity. And I think that was the days of Soros and Druckenmiller.
And from speaking with some currency traders, they actually think that the British pound is going to get below parity, so below 1-to-1 with the US dollar. So that would be for the first time in over 50 years. Now, the British economy, and I was looking at some analysts there from like the Financial Times and other financial publications headquartered out of London. They were talking about how the British government only has about $80 billion, give or take, of reserves, and they have to import so many things, energy, so oil, natural gas, because they're not fully energy dependent. Not fully energy independent, and they have to import all these other goods. It looks like the Bank of England, with those signed contracts with the G7, are going to be drawing a lot of US dollar emergency currency swap lines in the not too distant future. Just to fund import goods for basic items for British people.
No, absolutely. I mean, it's a mess over in Europe, especially in the UK. But I don't know if you perused the news today on the whole pound sterling crashing, and a lot of people are blaming it on tax cuts and how that's going to drive inflation. And I was thinking to myself, tax cuts can't drive inflation because that tax money, it's going to be spent by the government instead of individuals. It's going to be spent. It's not really going to increase the pool of British liquidity out there,
It's more complicated than just that. I mean, these governments are all so mismanaged. When the government cuts taxes, if they were managing their economy and their government finances properly, they should also cut government spending. But guess what? No one actually does that.
No, absolutely not.
No one actually does that.
And the Bank of England has been way behind the Fed with cutting, with increasing rates. So,
that's part of the problem.
Inflation. Absolutely, that's what's driving inflation.
Well, not just that, it's driving the stronger dollar. And then because of that, you're having these other currencies on their exchange rates against the dollar being devalued faster. So with the higher energy prices, you had countries like Norway that had a strong currency because of the high energy prices, but they're starting to give that back now. But a lot of these other countries, and we were talking about this, by the way, the dollar index hit, and we're recording this on Monday night, September 26, 2022. The dollar index was on fire. It got over 114 today. It's retreated a little bit, but you have experts like Brent Johnson and other people in that camp, the dollar milkshake theory. And we'll talk a little bit about the dollar milkshake theory. I think there's it's only partial credit. I actually came up, I think, with a better theory years ago. A lot of people are tweeting now about like the dollar wrecking ball. Lee, I was making videos in 2019 calling this a dollar wrecking ball. I doubt anyone's going to give me.
Well, it's something we've been talking about since we started the show.
This is a problem with the entire system, though, is there's too much debt, too much dollar-denominated debt. This thing works. This is part of my dollar tug of war thesis, is that every time the dollar gets weak, and then you have Peter Schiff and David Hunter saying the dollar is going lower, the dollar is going to crash. You have foreign governments and foreign central banks, and this happened in 2021 when the dollar index got around 89 or 90. You had all these people extrapolating that the downtrend was going lower. And then you saw record amounts of borrowing, especially in China, but from foreign governments and foreign central banks, even more dollar denominated debt. And then guess what? That creates more demand for dollars, because then you have to either service that dollar denominated debt or pay it back. Although at this point, I don't think it's going to get paid back because of all the problems in the euro dollar market and how dollar denominated debt has grown so much since the 2008 financial crisis. So there is at least 20 trillion in dollar denominated debt. The Bank of International Settlement says lower. Remember, I interviewed George Gammon a couple months ago, and he said it's at least 20 trillion for dollar denominated debt, because you have the euro dollar market, and then you have all this other dollar denominated debt for cross-border trade settlements and all this other stuff. So no one knows the exact number, except it's tens of trillions of dollars. And now you have a problem, Lee. This gets back to the dollar rising and all these economies. You have all these economies that are set up they need to run trade surpluses.
Mm-hmm.
So for the global economy in these countries, for their economies to work correctly, and for the U.S. Treasury market to work correctly, you have to, so the Fed doesn't have to do QE and buy all the treasuries. You have to have these countries, so like Japan, Germany, China, all the major exporters, they have to run trade surpluses. They need cheap energy. They need cheap electricity. They have to manufacture. And then they need the consumer here in the US, European Union, elsewhere to buy those consumer goods. And in those countries, take their trade surpluses, which turn into foreign exchange reserves, and then they recycle those into US treasuries. Well, that's not happening at all. None of those things that I mentioned.
No, and you know, this whole situation ties back to energy. I mean, Japan is the perfect example on what they've been doing. They've basically been selling U.S. treasuries, and they've been buying yen to strengthen the yen, because the yen has depreciated so much against the cost of energy, and Japan has no domestic energy infrastructure, really. So they have to import everything. And because the yen's gotten so weak against the dollar, like, energy costs are through the roof. So they need that energy because they're a manufacturing base. So now they're manipulating the Forex market to strengthen the yen so they could buy less expensive energy. It's crazy.
But can the consumer even afford to buy all these fancy discretionary items now? Because the consumer, and we've been talking about this for months, I've been talking about this for ahead of warning that the earnings for a lot of these S&P 500 companies were going to get killed with higher costs, and consumer demand for discretionary items were going to be non-existent. You're seeing the consumer now increase credit card debt. It's not to buy expensive things and discretionary items. It's for the basic necessities, everyday bills, living expenses, things like that. That's why credit card debt in the United States is ballooning. But you have these countries, though, that they need to run enormous trade surpluses, and they're not. The Wall Street Journal just ran an article about a month ago that foreign exchange reserves, which are mostly either, for a lot of countries, because we're still on a dollar standard, they're either in, and those are the most liquid, they're either in US dollars or treasuries. Those are the two main amounts. Well, besides a lot of other not a lot of other countries, but some of the big countries like China and Russia, India are accumulating more tonnage of physical gold.
Yeah,
I don't think those countries want to sell a lot of their gold. I mean, I think Ukraine sold 12 billion of their physical gold supposedly during the war a couple months ago, but that was probably bought quickly. But most of these larger countries do not want to sell their gold. The global economy is not working correctly. It reminds me a lot, actually, of what happened in 2019, 6 to 8 months prior to the pandemic. And during the 2019 repo madness crisis, the last time the Fed was doing quantitative tightening, which in English means trying to reduce their balance sheet, the Fed's official balance sheet, and then a rate hiking cycle.
And it sure would be interesting to look at that balance sheet. And you mentioned India. I don't know if you heard this story, but the State Bank of India has suspended trading with Bangladesh in U.S. dollars, and they're going to be settling trades in rupee and taka. So, this whole dollar issue is having ripple effects all throughout the world.
I think that's BS spin. From what I've heard from contacts, they're running out of dollars. I mean, China's short on dollars. One of the China contacts commented with that big spike in the Chinese premiums for physical gold was because China shut down gold imports because they don't have as many dollars to import as many commodities. Now, I don't know if that's fully true or not, because in the past, whenever GLD was raided, it was the physical gold shipments were sent by the bullion banks to whichever country, whether that was Turkey, India, China, whichever one had spiked premiums. So maybe it's a mix of both. But there is a dollar shortage because, as I explained earlier, these countries are not running enormous trade surpluses. And if they were running enormous trade surpluses, they would have plenty of dollars to either recycle into US treasuries, buy physical gold, or diversify. These other countries could diversify and go and make investments into other countries, like what China did with investing in Africa, or other types of examples like that. I mean, the Saudis are diversifying into technology. The Saudis are diversifying into nuclear power and other types of investments. At the country level, that's what you do when you run trade surpluses and have large foreign exchange reserves, or you can set up a large, it's not a pension fund, it's a sovereign wealth fund. You set up a sovereign wealth fund. So Norway, right, with these record high oil and natural gas prices, Norway then over the last 12 months, 18 months, they would have record amounts of profits from those to grow their sovereign wealth fund and make additional investments into a lot of other things.
We should talk about what's going on with the banks in Europe. I mean, the pressure must be unbelievable. Their investments right now, with the spike in the dollar and the sell-off in the equity markets.
Oh, they're going to get a lot of their derivatives trades are heavily leveraged. So you brought up the VIX earlier, Lee, and you were talking about how after the VIX spikes, then it comes down, and that could signal market bottom. There's over $3 trillion. Christopher Cole, the volatility hedge fund manager, says it's way over $3 trillion. So a lot of these portfolio managers, banks, hedge funds have this leverage short volatility trade on. And the longer the VIX goes up and the higher it goes, and the price point, the pain point starts around 30. Mm-hmm. So if it goes to 32, then 34, 36, 40, a lot of these professional investors, they've been collecting premiums on options, and they've been shorting the VIX, selling leverage short volatility trades on the VIX for years. And so these VIX spikes can blow up hedge funds and portfolio managers and investment banks. And that was part of the reason why the bailouts were so large in 2019 and early 2020.
Well, you also get those VIX spikes. I mean, they're a result of a sell-off in the equity markets, which is another thing that could really squeeze a hedge fund if they're long equities.
Well, the bond market, the spike in the 10-year yield and the bond market volatility leads even worse than stocks.
Yeah. Oh, look at the gilt. The yield on the gilt just went. I mean, I think they had the largest increase in percentage, I think, in history. I think it was 11% or some crazy number like that. I don't remember off the top of my head the exact number, but which is basically the British U.S. Treasury, if you will.
So in the alternative financial media, so Zero Hedge, bloggers, you're going to start to see articles come out saying China and Japan are going to dump their remaining treasuries. It's going to cause a default in the treasury market. It's going to crash the dollar. You're going to start to see that now because these countries desperately need cash. They need dollars. They desperately need cash. However, and I'll bring this up again because a lot of people either don't know or they forget, the Fed has already anticipated this because of what happened in 2019 with the repo madness crisis and also in early 2020. And in early 2021, Lee, the Fed set up 2 permanent repo facilities. One of them is a domestic one, and that allows not just banks to pledge collateral there and borrow from that repo facility at the domestic one, but real estate investment trust, private equity, pension funds. I think they can, commercial paper companies, they can keep changing whoever can borrow from the domestic repo one, but the permanent foreign one is for foreign central banks. And the Fed actually set that up to block a run on the treasury market. So another country like Japan or China dumping all their treasuries will not crash the treasury market. Instead, the permanent repo facility can actually block and set up bailouts in. So if those countries want to sell their treasuries, they don't have to fully sell them. They could just pledge them as collateral for short-term dollar loans without actually selling them. Or what the Fed could actually do then if they want, because let's be honest, no one's going to approve a full independent audit of the Fed anymore. The Fed could just once those treasuries are pledged as collateral at that foreign repo facility by another foreign central bank, the Fed could easily just give the other country the dollars, take the treasuries, stick them off balance sheet into a special purpose vehicle here in the United States or the Caribbean, somewhere else offshore, and no one's going to know. Well, except for the foreign central bankers.
It's crazy when you listen to what's actually going on and you realize what a synthetic economy we have going globally between the manipulation that's going on with the Bank of Japan and the Fed, and I'm sure all the European central banks are playing games as well. I mean, what's real anymore?
All smoke and mirrors. I mean, the narrative, what the Biden administration really needed before the November elections was to manipulate oil prices lower. And I would argue that they've done any means necessary.
Well, you were mentioning that you were talking to an oil trader and that they noticed that the prices were just getting slammed every morning. So.
Yeah, they told me it's almost exactly like gold and silver futures, that at 9 a.m. sharp Eastern Standard Time here in the United States, that oil futures just spikes down. now, daily, Monday through Friday. It's just smash.
Artificially fighting. I mean, it's like when you take a beach ball out in the water and you're trying to just push it down constantly and it just wants to come back up. Eventually, you're going to lose control and it's going to fly up into the air.
Well, you have politics trumping economics, and in the short term, that benefits politicians because they have election goals, and it does help the consumer a little bit. But long term, we're looking at supply problems, and a lot of these other countries are not going to make investments. Also, you have an increased amount just in the last 3 or 4 weeks, an increased amount of selling of strategic petroleum reserve oil. Hunter and Joe Biden increased the selling again.
Right. It's crazy what's going on. I mean, when I fill up my tank now, I'm like, okay, how long is this going to last? Because I know that whole strategic petroleum reserve going away and being sold off can only go for so long. And anything that they're doing in the futures market, it can only go on for so long. So where's the price of fuel going to be in, a year or two?
In the short term, we might go down substantially more, but then we're looking at a repeat very similar to the cycle from 2020 and 2021, where we go a little bit lower or substantially lower in the short term. And then long term, there's, I think this time what OPEC's going to do, and OPEC Plus, and you've had comments about a month ago from the Saudi oil minister, and they said they will cut more. But you've also had the Nigerian oil minister, who's in OPEC, say that they're going to increase oil production cuts as well. Also, the numbers, Lee, that came out from OPEC Plus, we haven't really heard anyone talking about this yet, but the actual production numbers, Reuters ran a story on this recently. OPEC Plus missed their production target goals by almost 4 million barrels per day. That was a big miss. That's a big miss. So while nonstop repetition from mainstream financial media, politicians, bureaucrats, not just in the United States, you're hearing this in the European Union, coming up with new draconian policies to try to kill demand. You just hear nonstop repeating of the phrase demand destruction. It is repeated dozens and dozens and dozens of times per day. It is Goebbels style propaganda. But if you just want to rationally cool-headed look at the numbers, I mean, OPEC's Plus's production collapsed again in August. So it's going to get very, very ugly. A lot.
Are the OPEC countries actually running out of reserves? I mean, are they depleting it, or are they just not producing?
I think it's a combination of the two things. I think there's gross mismanagement, corruption, waste, fraud, corruption, and abuse. I mean, Saudi Aramco had record profits, but a lot of these national oil companies, the Nigerian National Oil Company, due to corruption and mismanagement, they could not make an enormous profit on their oil and natural gas sales, even at triple-digit oil, for most of this year. So that's how inefficient these national oil companies, and these are governments that are running oil and natural gas production. So they're not efficiently run. They're not efficiently replacing oil and natural gas reserves. They're not doing smart acquisitions, because national oil companies don't do things like that. The Saudis to replace their oil production. So the Saudis have maintained their oil production. Their reserves, from speaking with a lot of people, are bogus because they kept the Ghawar oil reserves the same for 50 or 60 years. They never changed the number. But the Saudis, to replace their cheaper, lower cost oil production at the Ghawar wells, because that oil field has depleted, they brought online a lot of deep water offshore wells. So instead of their production costs between $10 a barrel and $30, their production costs are now $40, $50 a barrel. That's like the new floor for Saudi Aramco.
I had read, I thought it was Norway was cutting their natural gas production, but I can't find a story now.
Well, Norway has big opportunities to ship liquefied natural gas to Germany and the European Union. So there's big.
But they desperately need it too.
Yeah, so there's big profit opportunity there for the U.S. and Norway and in OPEC countries to ship liquefied natural gas to Germany and other parts of the European Union. Now they need to build more liquefied natural gas import facilities, but there are still facilities there, and then they could move the gas with pipeline or truck it to Germany and other areas.
We should talk about what effect all this is having on metal miners, copper miners, silver, because they are getting crushed with the energy costs.
Oh, yeah. So are emerging markets. I mean, it's a disaster. The numbers that came, I spent over 3 hours gathering from annual reports, quarterly reports, a lot of silver miner information. But there's been stories coming out from oilprice.com with base metal miners, so aluminum, steel, iron ore, copper, that these base metal miners, or earnings reports are giving warnings. They're absolutely getting crushed. Their profit margins are being destroyed. Much, much higher costs. If you're an emerging market country, your labor force wants higher wages to offset inflation. Your energy and electricity costs for diesel, gasoline, and electricity are through the roof. And now the metal that you sell is falling in price because commodities futures contracts are down. And I warned about this for silver miners back in February or March. This is the worst case scenario.
Yeah, oh, absolutely. I mean, it's with the price of silver being where it's at and gold, and then the price of energy, it just, why even produce anything?
Well, Lee, for gold miners actually have the best margins. So for now, let's see here. Let me pull up the gold price. The gold price is still above 1,600. It's at 1,630. So a lot of gold miners, we don't have the Q3 numbers yet for Newmont and the other guys. I suspect the costs are going to be around 1,300 or 1,400. So they still have some margins. Their free cash flow are down. But in that article that I just put out on Friday for patrons, and I spent over 3 hours on the research, the free cash flow for Hecla, and they are one of the lower cost silver miners now. The free cash flow for Hecla is down about 90% in 12 months.
I mean, that's crushing.
Yeah. So
they got to be looking at layoffs and other things.
Well, that's the problem with mine. So as I highlighted in the article, unlike other businesses, so if you're a restaurant business and you have different locations, you can close some locations. It's not so simple to cut costs for mining companies.
No.
It is much more difficult. And then also, if you put the mine on care and maintenance, it's still burning cash.
Of course, yeah.
So really, the main way actually for miners to cut costs is they actually have to make big capital investments into either growth CapEx or maintenance CapEx. There's big capital expenditure CapEx bills just to maintain property, plant, and equipment.
Mm-hmm.
And often for a lot of these miners to for a lot of these miners to lower their costs, say 20%, 30%, you're looking at 50 million to 200 million in investments into mill expansion or some new type of technology or equipment at the mine or the mill to lower the costs. And then that's not going to happen right away. So you're looking at enormous capital costs that the miners might not have because they don't have free cash flow. They don't have the profit margins. Profit margins dictate free cash flow. So for the listeners,
I said, of course.
Well, for the listeners out there who aren't familiar, the income statement, the profit margins are what end up turning into the free cash flow. So if you don't have the profit margins, you don't have the free cash flow. So for the listeners out there who want me to cut my Patreon prices down to $1, would destroy my income. I would need 5 times as many customers to make up the amount of revenues. It would totally destroy it would basically I'd be running the business at a loss.
Of course. And you can't do that for very long, and you're not in the charity business either. So,
well, in the miners, the capital for a lot of these miners is not available. So something in the next 6 or 12 months, either you're going to have a lot of supply come offline, and it's looking like the base metal miners are in the most trouble. The silver miners and the base metal miners are in the most trouble.
My understanding is most of them shut down in Europe because they just can't afford to run with the price, because the energy prices in Europe are much worse than they are here.
Oh, yeah. Same thing for Asia, same thing for Japan, same thing for China. Yeah, energy costs, diesel, electricity, they're through the roof. It's nuts.
Is there anything else you want to talk about?
Yeah, let me just pull it up. So the thing with the dollar, so the Dollar Tug of War, I did a video on this, I think in early 2020. You can look up Dollar Tug of War in the archives. How it's different than the dollar milkshake. So Brent Johnson, and he's a really smart guy. I'm friends with Brent. He used to be a gold fund manager. I think now he's mostly U.S. Treasuries, which are not doing well. A lot of these guys that have been predicting the dollar rally, they were also long U.S. Treasuries, betting on gains in their bonds, and those have gotten crushed. I think this is the worst performing yearly for being a bond fund manager in U.S. Treasuries since the 1920s.
It's pretty much the worst year for managing any kind of financial portfolio. It's been a tough year all around.
Well, energy was doing very, very well up until the last 6 to 8 weeks.
Mm-hmm.
So you had energy doing very, very well. I still think long term, there's enormous food and energy problems. Governments government's trying to restrict demand, kill demand, trying to ration, trying to what's going on in Europe and Germany with these draconian policies. It's not going to fix the energy crisis long term.
No, definitely not. I mean, you saw Germany's in final stages of nationalizing one of their utility companies. So, I mean, that's basically the final step that any government can take. And it's just like really just pushing everything over the cliff at that point.
But back to the dollar milkshake. So the dollar milkshake, Brent is predicting, I think, a big run up in the dollar index still to 120 and then even above 120. The problem is that, and we talked about this a little bit earlier in the show, that so many of these banks, especially European banks, but also American investment banks and these large hedge funds, have so many leverage bets on the VIX, leverage bets on currencies, stocks, bonds, derivatives, all the interest rates, all these different things, that before the dollar index gets to 125, 130, I would suspect that we're going to start to hear maybe even announcements publicly, press releases that banks have failed and needed bailouts.
It would not surprise me at all.
And it's going to be European. From speaking with contacts, it sounds like the European banks, because now you have so many bad trades. You have the euro very weak against the dollar, the British pound very, very weak against the dollar. You have the German economy destroyed by high energy costs, and they're not exporting anywhere near the levels that they needed to with their trade to run trade surpluses and then recycle their reserves. So all these problems, and on top of that, now you have potentially dollar pegs in Hong Kong. I know a lot of traders have been criticizing Kyle Bass for timing of when his Hong Kong dollar peg will break. Well, I mean, China has a dollar shortage right now. I've heard it from a bunch of different people. Their economy is not exporting to the levels. They take breaks from importing certain commodities. Looks like they may have taken a small break or reduced the amount of gold imports slightly. So we'll see. Although I think gold imports spiked from Turkey. I think there was a big spike in gold imports into Turkey from Swiss gold refiners that were exporting to Turkey. But anyway, though, you're looking at a lot of problems because the dollar and the global economy is not running the way it's supposed to. The dollar milkshake, actually, Brent, I would say he correctly identified exactly what happened from 2009 to 2019.
Yeah. And then the world changed in 2019 and everything was just accelerating away from the factors that drove that dollar milkshake theory.
Well, let's touch on that a little bit as we wrap things up here. So what Brent says with the dollar milkshake theory, so his main long thesis, I think, is to be long U.S. Treasuries and the dollar. He's correctly predicted the dollar rally to this point. We'll see what the Fed does with the permanent repo facilities and currency swap lines and rules changes. There's a lot of hidden bailouts and other stuff the Fed can do, because I think they're well aware after what happened in the 2019 repo madness crisis and in 2020, when the dollar index took off and then they monkey hammered it back down in early 2020, the dollar index keeps rallying. I mean, there's going to be bank failures. There's going to be bank bailouts needed. Well, they'll do the bailouts. I don't think at this point the Fed will let a Japanese investment bank fail or a European investment bank fail, because in 2019 and 2020, they were bailing them out. We found this out from New York Fed disclosures, thanks to Dodd-Frank.
Oh, what a crazy world, Jason.
Sorry, I didn't explain the rest of the dollar milkshake theory. So Brent says that all this flight capital, this foreign capital, will come into the United States, and it will buy U.S. real estate. It will buy U.S. stocks. It will buy our best real estate. It will buy our best stocks, and it will buy U.S. Treasuries. Well, we haven't, the last month or so, as the Fed raises interest rates more and countries don't run trade surpluses, we've had problems in the U.S. Treasury market, and the Fed hasn't even done real quantitative tightening yet. So there's not foreign demand for U.S. Treasuries, at least not yet. And from 2009 to 2019, I mean, I was hearing a bunch of stories, and there was tons of articles on this. Foreigners, whether they were from China, the European Union, the United Kingdom, there were Canada, Australia, there were many foreigners who were buying U.S. real estate in California, Arizona, Florida, because it was cheaper to retire in those states than it was to retire in the Mediterranean in Europe or other normal retirement areas. So,
well, it's interesting though, is that so many people here moved to those areas as well over the past 2 years, which drove prices up significantly from a few years ago.
Well, prices were already up. My point, though, is prices, if you look at when real estate crashed from 2009 to 2012-ish, because back then the sentiment after the first crash in the 2008 financial crisis, the sentiment was that housing prices would not go up for a lot. But look at all the games the Fed played. They gave private equity, BlackRock, hedge funds, they gave them all this free capital, almost 0% interest rates to go and buy entire neighborhoods of houses, to go and buy mortgage-backed securities off the Fed's balance sheet. The Fed basically gave these guys free capital to go and drive prices back up. But you had foreigners for over a decade buying U.S. real estate, buying U.S. stocks, and buying U.S. treasuries because they viewed them as safer and better. So that was the dollar milkshake theory minus the big spike in the dollar index. So that was actually already happening prior to 2020 and the dollar index spiking then, and then prior to the dollar index spiking now. So will we see foreigners and flight capital, panic capital start to buy U.S. assets like crazy, kind of like a hyperinflation scenario where anyone takes their dollars or their currency and they have to buy something, they have to buy anything in dollars, they don't want to hold the currency. We don't see signs of that. We don't see enormous demand for U.S. treasuries. It's the opposite. I see a lot of people waiting to buy houses now. People like, well, I want to see when the Fed's done raising interest rates, because even if you pay all cash right now, if the Fed raises interest rates, your property value could fall. So
absolutely, because no one's going to want.
And then if you need a mortgage now, your costs are up a lot.
Good luck trying to get one too, I would imagine. I mean, I don't know if you remember, but when Mitsubishi, what was the Mitsubishi Group bought Rock Center back in the 1980s during the bubble?
That was about the peak of Japan. No, I've read about it.
Yeah. So,
well, didn't they buy Pebble Beach Golf Course?
I believe so too. Yeah, they bought a bunch, but it's the same kind of thing. I mean, they're investing, and then all of a sudden, the investments go the other way.
I don't remember the exact numbers because I was only reading about it and then asking people who these are like investment bankers who are working in Japan at the time. And they were telling me about like the square footage costs in Tokyo. So the real estate costs in Japan are still very high, but they were astronomically high at the peak of their bubble. I mean, that's what happened in China, but now you're seeing the Chinese housing bubble collapse too. So you're seeing all these property bubbles in China, Australia, London, Canada, and the United States. The United States has the they don't have the larger amount of real estate crash yet. Although in some areas we're starting to see some big decline in sales and property values falling. And I think even the homeowners, the people want to sell their house, the seller now is willing to pay a lot of the closing costs. So those are signs of desperation that the sellers want to get out.
Oh, no doubt about it. That's definitely a sign. There's actually a current article on Zero Hedge about New York City office space being in a major glut, especially the older buildings.
Silicon Valley's even worse, Lee.
Yeah. So I think
most of those companies never had any profit.
Yeah, exactly. I just trying to make the point that I think there's some pain to come in the real estate space.
Oh, I totally agree. It's just a question of how big of a crash the U.S. is going to have. Although I think the crash is going to be worse in areas like Canada, Australia, London, and China.
It's going to be interesting to see how it plays out.
So as we wrap up here, then, if the more the dollar rallies, if it does rally more, Lee thinks actually, Lee, didn't you say that you think that the dollar index you said it's euphoric high and it's spiking and it's probably way overcrowded, this trade?
Yeah, I think it's overdone. I mean, that's not to say that it couldn't like rally in the future, but I think for the time being, I think we're going to see a pullback, probably going to, test around the 110, 111 mark over the next couple of weeks. That would be my guess on the way things are going to play out.
That could be some profit taking then from some of these traders that were long the dollar that were betting on this big rally. So that would be some profit taking. But I mean, if the dollar index does go to 120 and beyond, which is what Brent Johnson is predicting, I mean, you're looking at immense amounts of pain.
Oh, no doubt about it.
So people have used like the dollar wrecking ball. I think that's actually accurate. I coined that term again in 2019. I was the one who was making the YouTube videos. I'm sure a lot of these hedge fund guys that are posting on Twitter and FinTwit watch some of these videos and not going to give me credit for it. I also came up with the term repo madness for the 2019 that everyone uses now too. Bloomberg was even using that within a couple months because I made so many videos on it.
Oh, that's so funny. Yeah, I mean, the dollar's come a long way. I mean, back in, what was it? It wasn't long ago. It was just, I think it was
it was about 12 months ago.
It was like May of 21, where it was
summer
80, 88, 89. And I mean, we're looking at 100, 113 or so.
And I was predicting a rally back then because I was reading the article, seeing that there was increased amount of dollar denominated debt borrowing. Mm-hmm. And I know how the system works and I know how these cycles work. And it's just what foreign governments and foreign corporations like to do. They play these currency games and they try to guess which currency will go up and down, especially the dollar, and they try to get a little extra gain there borrowing, and then they get screwed. And this stuff happens every like 2 to 5 years now.
Yeah, it's a vicious cycle. So
there's too much debt and too much leverage in the system on these trades. That's the bottom line.
And, before we say goodbye, I just want to mention that I'm putting out a video tomorrow night on my channel Risk, and it's a continuation of last week's discussion on ESG and sustainable investing. I think it's pretty important information and everyone should check out.
And if I could wrap things up here, there's not a lot of safe things on the long side. So again, I ask, what's cheap and what's hated? Is there anything hated on this planet more than gold stocks right now? I mean, I'm getting the nonstop hate mail. I'm literally, so this is normally the sentiment you see right at bottoms from retail investors. I'm getting nonstop comments below videos, emails, Patreon messages. I hate you. I never want to buy silver stocks again. I never want to touch gold stocks again. I'm buying Bitcoin and crypto on the dip.
I've gotten some comments too on my position in silver, but people don't understand that I've been buying silver for the past year or so for much longer term play. I'm not trading this. This isn't like an in and out swing trade. And I think people really have to understand that you're also more of a long-term strategic player when it comes to investing. It's not day trading that we're talking about.
Or it's a swing trade. So it could be over a couple months, 6 months, or a couple years. So you're looking for something. You're looking for a low cost producer that doesn't have too much debt, that can survive lower prices, that can survive capital not being available because they already have cash on the balance sheet. So if you're looking for companies in the natural resource sector, that's what you have to do. Now, I think there is an opportunity, unless oil prices totally crash, I think there is an opportunity to hide, at least for now. We'll see if things change depending upon oil and natural gas prices, because I mean, the prices could go, we've had a substantial corrections in oil and natural gas lately, but at the current prices we have now, the pipeline companies and their cash flow and their dividend yield are still pretty good. So we'll see what...
I was going to say, as far as that goes, you really have to look at what's going on with the Strategic Petroleum Reserve. I mean, it's artificial manipulation. So we're pulling back now. I mean,
more than one type of manipulation.
Absolutely. I mean, so you got to put that in context.
Well, so you have the mainstream financial media, politicians, bureaucrats, regulators. You have them mentioning the phrase demand destruction. So it's Goebbels, it's Joseph Goebbels levels propaganda. They just keep repeating demand destruction, demand destruction, demand destruction. You see comments on Twitter, demand destruction. Okay, show me the actual evidence. Show me the proof that demand has collapsed. show me the statistics that justifies the oil price and 9 a.m. futures trading contracts being smashed and the Strategic Petroleum Reserve being dumped. Okay, so this is politics and market manipulation for short-term political goals trumping. And we're going to have supply side problems, commodities for years. It's going to get, again, in the short term, anything can happen. Commodities prices, these hedge funds, what they do, the high frequency trading algorithms, they are programmed. We've talked about this, Lee, and I've talked about this in interviews with gold fund managers like John Hathaway and others. These high frequency trading algorithm programs are programmed that as soon as the dollar index goes down, short gold futures, short commodity futures, short gold mining stocks, short copper. So these things are programmed. So in the short term, that's what will happen. You will have the downtrend forced lower by these traders, but that will create even more supply side problems 6, 12, 18 months from now. You're going to have the supply side people say that's enough. Either you're going to have miners shut off supply or go bankrupt or force merger and acquisitions, like what happened with Alexco, which did not have access to capital and their costs were too high for a silver miner. They had to sell the company to Hecla. So Hecla is a lower cost silver miner right now. Their balance sheet is far better than Alexco, but Hecla's free cash flow is still down 90% in 12 months. So even though they're the low cost silver miner, or one of the low cost silver miners now, their free cash flows, their profit margins have eroded and their free cash flow is still down 90% in 12 months. So that's not sustainable either, or the amount of silver supply, because a lot of about 20%, 25% of annual silver supplies from silver miners, that supply is going to be in jeopardy because the miners are not going to be able to run at losses if silver prices go another couple dollars an ounce lower.
No, absolutely not. And, with the dollar being what it was, it really has put pressure on precious metals. And I think that trend is reversing, or at least will pull back. So we'll see what happens. And it'll definitely be an interesting next few months.
Well, let me just talk as we wrap up now that I've had off the record discussions with a good amount of hedge fund managers that I've interviewed, and they're not gold people. So these guys are not gold bugs. These guys are global macro specialists. They go in and out of trades. They look for good risk reward opportunities in different sectors. And almost all of them that I've interviewed, and the discussions about gold, a lot of the stuff were not on the recordings. They were afterwards. Almost all of them, overwhelming majority, have said they expect gold prices to rocket higher once the Fed comes out and admits that they cannot raise interest rates anymore and they're done with quantitative tightening. And that's when these hedge fund guys said, that's when we're buying gold. That's when we're buying gold stocks, and they're going to go bonkers.
It makes sense to me.
Okay, well, this is episode number 10 of Finance Unspun. I hope you enjoyed it. You have to watch the dollar. We may never find out the truth about a lot of these investment banks. There's going to have to be a lot of bailouts if the dollar keeps rallying, unfortunately. But the problem, again, too much total debt in the system for government debt and corporate debt.
And too much manipulation. Well,
also, you have inflation in the system and stagflation that's causing problems for the real economy and all these businesses. And then the over leveraged trades, so the derivatives market and all the leverage on these trades, and that's going to cause the problem. So the VIX spiking, these leveraged bond trades, these leveraged currency trades. There were banks that needed bailouts when Brexit because there were currency problems and the currency markets moved the wrong way. So these banks and hedge funds that had leveraged currency bets on the wrong side of the trade, they blew up. They needed bailouts. The European Central Bank drew. And I found this out from a Fed disclosure, a Federal Reserve Bank. Every 6 months, they release a distress report about what the weaknesses in markets, and they released a chart about currency swap line increases. And it's not what the Fed was telling people, that the currency swap lines were not being drawn after 2010. Their chart showed the truth, that there was a ton of currency swap line disclosures by the European Central Bank every couple of years after 2010. Through Brexit in 2019. So unfortunately, it's smoke and mirrors, and the Fed does most of the bailouts for the entire global economy.
Yeah, they try and manipulate it all. Well, Jason, thank you so much. It's been a great discussion again.